Greetings. It's January 4th, 2012, and this video I want to go over some different option strategies that you can use in your own option trading. I'm going to highlight one, two, three, maybe four different strategies if we have time. I don't want to go into too much detail, but I just want to show you how they work and how they would work out if you would do them in your own. Without further ado, let's go ahead and get into them. The first one I'm going to show you is what's called a naked put. And that position is right here. This is what it would show up as in your trading screen if you're using this. This broker in particular, which is Thinkorswim, now owned by TD Ameritrade, but you'll see something like this in your own broker. Basically, what this is saying here is that you have 42 days to expiration. I am short 2 February 84 puts. The price right now of these puts is 49 cents. They've gone down in price 6 cents today, which means a profit of $80. And as you can see, that's the profit of today and the profit since the open, because I've just got into this trade today. And here is the margin. So it's about $600 in margin currently. Made $80 so far today. This, keep in mind, this is a oil futures options contract. So the margin is done very differently than normal stock options. So I just want to show you the trade because you can do the same types of trades in futures as well. So let's go ahead and set this up. Okay. All right. So this line right here, this is the price of oil currently. It's at 103.75. This is the February contract, I believe. My short is at 84, so that'd be all the way down here, and the break even is 83.45. That number right there, that's the break even. So the way a short put works is that as long as the price of the underlying is above our strike, we make money. So as you can see, take a look at this red number right here. As you can see, anywhere above this line, that red number stays the same, and I can make a maximum of $1,060. So it doesn't matter how far oil goes up, or if it comes down all the way down to my short strike. Oops. If it comes all the way down to my short strike, I can still make $1,060. Now, the downside of this trade is once you pass the short strike, look at that number, look at that red number, and you see how fast it comes down. So, you know, if you're going from 84 to just 80, right around there is 80, you're already down almost $7,000. So when you're selling naked puts, you don't want it to go below the short strike. You don't even want it anywhere near your short strike. So that's why this trade is, you know, since oil is at 103, 104 today, I put it on at 84, which is 20 points away, or about 20% away from the money. So that is a naked put. The next thing I want to show you is a butterfly. Now this is a classic butterfly on Berkshire Hathaway B shares. Let's go and set this up for the break evens. Okay. So now this is one break even. This is the other break even. This is a non-directional trade, saying that Berkshire is going to stay in this range pretty much. And if it does stay in that range, then we can make money. We can go ahead and delete this slice for a second. And according to this, I have a 45% chance of this trade making money. Currently, the trade is already up $65. You can see that in the light blue number right there. If you put it where the price is right now, it's already made $65. And this trade cost around I don't have that number with me, but what you can do is that you can actually, let's figure it out from right here. So classic butterfly is long 2 options, short 4, and then long 2 more. So this is a 2-4-2 classic butterfly. You have the shorts in the middle. So this one is centered right at 77.5. These are calls. So 77.5 is right there. As you can see, that's directly in the middle. And that's what we want our price to stay at. We want it to stay at right around. That's how we make the most money, if it stays at 77.5. So as you can see in the red number, at expiration, we can make around $470 on this trade. Currently, we've already made 65, but anywhere in between these two numbers, you make money in this trade. If Berkshire is within these two break-evens. So now let's go ahead and let me really calculator this and see what the cost was on this trade. 4.25 plus 4.25, since there's two of them, is 8.5 minus 0.86 minus 0.86 minus 0.86 minus 0.86 equals 5.06 plus 0.06 plus 0.06 equals 518 time. Okay, so this trade, I believe this trade cost me about $500. $518 to be precise. So I'm gonna. So this trade cost me about $518. So far, I'm already up $66, which means I'm up more than 10% already. And as I said, today is the 4th of January. Let's see when we got in this trade. I got into it on the 22nd. So that's roughly about 2 weeks. Almost 2 weeks. So in 2 weeks, I've already made 10% on this butterfly, which is good, but I can make a lot more. I can make all the way up to 475, which is almost 100%. If it stays in this range, I would be happy with a nice 20% profit. What we can do is we can also take a look at how it looks on the chart. And you can see that that red line and that red line, those are our two break-evens. So as long as it stays within the break-evens, and again, the statistics say we have a 45% chance of it staying within these lines. I'll probably let it go another week or so, take as much as I can, and then get out. Even if I'm up 15, 16%, I'll be happy and I'll be out of this trade. Okay, so that was the butterfly. We've looked at the naked put. We're going to go take a look at a iron condor. Now this is an iron condor in Las Vegas Sands. An iron condor is basically two credit spreads far out of the money. You have a put credit spread, you also have a call credit spread, and this sets up this little square here. Earlier this week somebody told me this is it's called a mesa. It's like a table. Looks like a table. Mesa is the Spanish word for table. So, you know, you can call it a table, you can call it a box, you can call it whatever you want. But over here, our break-evens are over here at about 35.75 and 55.29. Currently, the stock is at 43.79. So as you can see, it can go down a lot and it can go up a lot, and this trade will still make money. Actually, if you look at it, that's where it is right now. This trade has already made $101, and the maximum it can make is $112. So what I'm going to do, there's 2 weeks left. I'm probably just going to go ahead and let this trade expire. As you can see from here, $1,000 is the maximum I could lose. Actually, the maximum I could lose is a little bit less than this, because it would be $1,000 minus the credit that I received, and the credit that I received is the most I can make, so it's $112. So again, I'll go to my calculator. 1,000 minus 112 is $888 is the margin that was required. So 112 divided by 888 equals 12.6% is the profit on this trade without counting commissions. And let's see, when did we get in this trade? This was done on the 6th. So it's been right about a month. It's been pretty close to a month that I have been in this Condor. And let's take a look at it on the graph and see how much room I actually had. Okay, so this was the break-even on the low side, and the break-even on the high side is not even on the graph. It's so far up there that it's not even showing up on the graph. So let's see if I can make this. Yeah, there we go. So this is the break-even on the low side. This is the break-even on the high side. As you can see, this stock, going back to October, about a year ago, over a year and some. Since then, it has been in the range that of this trade. So I could have done this stock. You could do this Condor over and over. You could have done it every month, over and over and over and over and over. The same numbers, the same strikes, and it would have made money. So as you can see, this stock, this trade, going to make me around 12.5%, 12.6%. And currently, I don't have to do anything. I'm just going to let these expire since these are credit spread on the put side, credit spread on the call side. As you can see, these were the actual numbers right here. I sold the 36, yeah, I sold the 36 puts, bought the 34 puts, sold the 55 calls, and bought the 57 and a half calls. So I did one put credit spread, one call spread, and that's all there was to it. I put it on. I haven't adjusted this trade, haven't had to do anything to the trade. As you can see, LVS is channeling, and a channeling stock is great for an iron condor. Let's see. So we've been going for about 12 minutes. Let's do one more. Okay. This is another trade I've done on LVS because LVS is channeling. This is two naked options. I have a naked put and I have a naked call. You add these together, it becomes what's called a strangle. Let me go ahead and set those slices here. Okay. So now what this trade is saying is that anywhere, if LVS at expiration is anywhere between 37 and 48, this trade will make money. Okay. Anywhere between 37 and 48. And these were the prices I got, 29 cents and 26 cents. So let's see, 29 plus 26 is 55 cents. It's the credit that I received. Currently, the trade is already up $29.50. I don't think this trade is in any danger of going and hurting me one way or the other. So I'm just going to let this trade sit, and hopefully these two will expire. I only did one contract, and I did 4 contracts of these because this is my example account. I'm just showing, this is one of my smaller trading accounts. I play with it, and I use it to make videos and show members of the Option Genius website different strategies and different trades that I'm doing that they can also follow along with. These are not part of the Option Genius portfolio, and none of these trades are meant to be traded actually. They're meant to be paper traded. So, I just wanted to do this video to show you some of the strategies that are out there, some of the strategies that you can use that can make money on. As you can see, we have a butterfly that's working. We have some naked puts that's working. We have a iron condor that's been working, and we have, these two short puts that are, or these two short options, a put and a call option put together, that are also working. So there are many different ways to play stocks and options. There are many ways to play non-directional stocks, many strategies that you can use. Some of them can make you 10% a month, some can make you even more. The butterfly might make a lot more. I'll be happy with about 15 or 20% on that one. The iron condor here, I'm happy with 12% or even 10%. So normally what I do is I'll put on a trade if I can make at least 10%, and then I'll try to get out with as much as I can. So if the trade gets in trouble and it looks like it's going to start losing money, then I'll probably just pull the plug and get out. But I like to make 10% on every trade. At least I will not get into a trade if I can't make at least close to 10%. That's it for this video. I hope you guys learned something. Again, this was a very basic beginning video, but I should get to show you 4 different option strategies that you can start using in the paper trading. These are not very easy strategies to play with if you get into trouble. So if you do get into trouble, then you have to know how to adjust them. That would be covered in a different video that would be on the website. But these are just some basic strategies that you can start using, and some of the strategies that we cover and we teach in the Option Genius class, in the Option Genius website, membership site. So if you have any questions, please email us, and look to see you on the next video.